10%. That is the penalty you could trigger by moving your 401k into an IRA, because the rollover can erase up to 4.5 years of penalty-free access to your own retirement money. If you leave your employer in or after the calendar year you turn 55, the rule of 55 may let you withdraw from that employer's 401k without waiting until age 59 and a half. Move the money first, and that exception disappears. On a $100,000 withdrawal, that difference can mean $10,000 sent to the IRS. You still owe ordinary income tax on pre-tax withdrawals either way. The 10% is an additional tax created by choosing the wrong account before choosing the right withdrawal. This is why I went through the 86 pages of IRS publications, rollover instructions, and Form 8606 material behind this decision. The interesting part was not the rollover procedure. That section is boring even by IRS standards. The interesting part was discovering how much conventional rollover advice ignores once it finishes comparing investment menus and expense ratios. An IRA can be excellent. You may get broader investment choices, lower fees, easier account management, and more control. If your old 401k charges ridiculous administrative fees and offers 12 funds apparently selected during the fax machine era, moving it may be reasonable. But the usual comparison is incomplete. It treats a 401k and an IRA as two investment containers with different prices. Legally and strategically, they are different machines. A rollover can cost you three things that do not appear in the performance chart your provider shows you. The first is early access under the Rule of 55. The second is the federal creditor protection generally attached to an ERISA-covered workplace plan. The third is clean access to the Backdoor Roth strategy, because a pre-tax IRA balance activates the pro-rata calculation. The mistake is not rolling over. The mistake is rolling over automatically. That distinction matters because a rollover is usually irreversible in the moment when these benefits are most valuable. You can often move money from an IRA into a future employer plan if that plan accepts incoming rollovers, but you cannot assume that option will exist. You may already be retired, your next employer may reject rollovers, or the plan may accept some money but not every account type. The first thing at risk is the Rule of 55. The official name is an exception to the 10% additional tax for distributions after separation from service. The useful name is the Rule of 55 because nobody wants to say Internal Revenue Code Section 72T, Paragraph 2, Subparagraph A, Clause 5 before breakfast. The rule says that if you separate from service during or after the calendar year in which you reach age 55, distributions from the qualifying employer plan can avoid the 10% early distribution tax. You do not need to wait for your 55th birthday if you will turn 55 later in that same calendar year. That calendar year detail creates a planning opportunity. Suppose your birthday is in November and you leave work in February of the year you turn 55. You can potentially qualify even though you were 54 on your final day. The IRS looks at the year in which you reach the qualifying age. The reverse is much less friendly. If you leave the employer at 54 during the year before you turn 55, waiting another year does not repair the problem. The timing requirement concerns when the separation happened, not merely your age when you eventually request the money. That is not the rule. Your old accounts do not automatically inherit the exception because you turned 55 somewhere else. If you left an earlier employer at 47 and its 401k is still sitting there, reaching 55 does not retroactively turn that old separation into a qualifying one. The account connected to the employer you leave in the qualifying year is the important account. That is why moving old workplace balances into your current 401k before you separate can be strategically useful, provided the current plan accepts incoming rollovers. Once the money is inside that plan, it may become part of the balance available after your qualifying separation. The order matters. Consolidating the money before leaving may expand your bridge. Rolling the current plan into an IRA after leaving destroys the Rule of 55 treatment for future IRA distributions. The IRS exception applies to qualified workplace plans, not ordinary IRA withdrawals. Imagine you plan to stop working at 55 and need $50,000 a year from retirement assets until age 59 and a half. That bridge could require roughly $225,000. If every dollar were otherwise exposed to the 10% additional tax, the potential penalty would be $22,500. That is not a projection based on stock market guesses. It is the arithmetic consequence of account location. You could avoid the penalty through other exceptions. One alternative is a schedule of substantially equal periodic payments, commonly called a 72T plan, but that method comes with a rigid calculation and a required payment period. Changing the schedule incorrectly can cause the IRS to recapture penalties. The Rule of 55 can offer more flexibility when the employer plan permits the withdrawals you need. That last sentence is where another trap is hiding. Federal tax law creates the exception, but your plan document controls how money can come out of the plan. The IRS says a plan is not required to allow every distribution form the law permits. One plan might allow monthly withdrawals after separation. Another might permit one distribution per year. A third may offer partial withdrawals but charge a processing fee. A particularly unhelpful plan may push you toward a lump sum, which makes a flexible retirement income strategy much harder. You therefore need the summary plan description and, when the summary is vague, the actual distribution document. Ask whether separated employees can take partial distributions, how frequently withdrawals are allowed, whether there is a minimum amount, what fees apply, and whether the plan accepts inbound rollovers before you leave. That phrasing often produces an answer assembled from confidence and office carpeting. Ask what distribution options are available after separation during the calendar year you turn 55, and ask where those terms appear in writing. If reading the document that controls your retirement account sounds more useful than taking financial folklore on faith, subscribe. I read this material so your Saturday does not have to die in a pension glossary. The plan does not need a special investment for the rule. You can still hold broad index funds, stable value funds, bonds, or whatever the menu provides. The issue is whether the money remains in the qualifying legal container and whether the administrator will distribute it in a usable form. You also do not need to keep every dollar there. A partial rollover can sometimes give you both flexibility and access. You might leave enough in the 401k to fund the years before 59.5, then move the excess to an IRA for lower cost investments or better withdrawal tools. The amount you keep should not be a random round number. Estimate your spending gap. Subtract income from taxable accounts, part-time work, a spouse's earnings, or other sources. Then add a margin for taxes and market volatility. The result is the portion performing a specific job inside the 401k. That is a different way to think about account consolidation. Your taxable brokerage account may fund early years without retirement account restrictions. Your 401k may provide Rule of 55 access. Your Roth account may hold tax-free assets for later flexibility. Your IRA may offer conversion opportunities. The accounts are not clutter when each one has a reason to exist. I have spent more than 10 years running my own business around accountants and tax lawyers, and they taught me that money decisions are often controlled by legal structure before investment performance enters the room. I also have multiple hundreds of thousands of dollars invested, so I am not treating this as a vocabulary exercise. Account labels can determine who can reach the money, when you can use it, and how the tax return interprets the movement. That leads to the second thing you surrender in a rollover, ERISA protection. Most private employer 401k plans are covered by the Employee Retirement Income Security Act. ERISA includes an anti-alienation rule. In normal language, benefits held inside a covered plan generally cannot be assigned or seized by ordinary creditors. There are exceptions, including qualified domestic relations orders and certain government claims. But the baseline protection is powerful and federal. Government and some church plans are different, so you must confirm whether your account is actually covered. The account nickname on your website does not settle that question. IRAs also have meaningful protection, especially in bankruptcy. This is not a claim that moving $1 into an IRA invites a man with a clipboard to confiscate it. Federal bankruptcy law protects qualifying retirement funds, and properly traced rollover assets may receive substantial protection. The difference becomes important outside bankruptcy. An IRA generally does not carry the same ERISA anti-alienation shield. Protection against ordinary creditors and legal judgments can depend on state law, the type of IRA, the source of the funds, and the circumstances of the claim. That variation matters more to some people than others. If you are a business owner, physician, landlord, contractor, or anyone with elevated lawsuit exposure, creditor protection is not an abstract footnote. It is part of the return you receive from the account structure. Suppose two accounts each hold $1 million in the same index fund. They produce the same market return. One sits inside an ERISA-covered 401k. The other sits inside an IRA, governed by a different set of protections outside bankruptcy. The brokerage screen shows two nearly identical portfolios, but a lawyer sees two different assets. The rollover sales pitch usually prices the visible difference. The IRA fund might cost 5 basis points less. The invisible difference is the legal shield you surrendered to obtain that saving. Sometimes the trade is still worth making. A terrible 401k can impose high expenses, bad investments, and restrictive administration. But you should compare the fee savings with the value of the protection based on your real exposure, not act as if creditor law is worth zero because it does not appear in a Morningstar chart. You also need clean records if you move rollover assets. Mixing workplace rollover money with annual IRA contributions may complicate tracing and future plan-to-plan movement. The IRS allows pre-tax IRA money to move back into a qualified employer plan when the plan accepts it, but the receiving administrator can demand documentation showing that the rollover is eligible. The label can help with record keeping. It does not turn an individual account back into an employer plan. This is where personalized legal advice can be worth paying for. Ask an asset protection attorney in your state what happens to an IRA outside bankruptcy, what exemptions apply, and whether rollover funds receive different treatment. Cybersecurity and creditor protection are entirely different questions. If you appreciate finance that includes the inconvenient legal pages, subscribe. The expensive mistakes tend to live in the paragraphs everyone skips. The third loss is the one that surprises high earners several years after the rollover: the ability to make clean backdoor Roth contributions. A backdoor Roth is a two-step transaction. You make a non-deductible contribution to a traditional IRA, then convert that money to a Roth IRA. In 2026, the standard IRA contribution limit is $7,500, with a higher limit for eligible people age 50 or older. The strategy works cleanly when you have little or no other pre-tax money in traditional SEP or simple IRAs. Form 8606 aggregates your traditional IRAs. The calculation considers your total basis, distributions, and conversions, and the year-end value of all traditional IRAs, including traditional SEP and simple IRAs. Opening the new account at a different brokerage changes nothing. The IRS sees one combined bucket. Suppose you roll $742,500 of pre-tax 401k money into an IRA. Later, you contribute $7,500 of non-deductible money and convert $7,500 to Roth. Your total IRA pool is effectively $750,000 for the pro-rata calculation. The after-tax basis is 1% of that pool. Roughly $75 of the conversion is tax-free. The remaining $7,425 is taxable. You attempted a backdoor Roth contribution and instead created a mostly taxable Roth conversion. Leaving the pre-tax money in the 401k would have avoided that problem because 401k balances are not included in the IRA pro-rata calculation. The location of the pre-tax money determines whether the backdoor remains clean. This is especially relevant if your income prevents a direct Roth IRA contribution. For 2026, the direct contribution phase-out begins at $153,000 for single filers and $242,000 for married couples filing jointly. Higher earners often discover the backdoor strategy only after they have moved an old workplace balance into an IRA. By then, the elegant rollover has become a plumbing blockage. There may be a repair. If you later join an employer plan that accepts incoming IRA rollovers, you may be able to move eligible pre-tax IRA money into that plan. The IRS has a special rule that can allow the taxable portion to move while your after-tax basis remains behind. If the transaction is completed correctly and your relevant year-end IRA balance reaches zero, future backdoor Roth conversions may become clean again. But the employer plan is not required to accept the money. Its administrator may request tax forms, account statements, contribution histories, or certification from the custodian. You are now depending on a future plan's rules to restore an option you previously owned. Another repair is converting the entire pre-tax IRA to Roth and paying the resulting income tax. That can make sense in a low-income year, but converting hundreds of thousands of dollars can push income into higher brackets, increase Medicare premiums later, affect deductions or credits, and create a tax bill large enough to qualify as a home renovation. The cleanest strategy is often prevention. Before rolling a 401k into an IRA, ask whether you currently use or may eventually use the backdoor Roth. Include your spouse's accounts in the discussion. because pro-rata calculations are individual but household tax planning is connected. One spouse's IRA balance does not enter the other spouse's Form 8606, yet the combined tax bill still belongs to the household. This is the point where conventional rollover wisdom starts looking less like wisdom and more like a spreadsheet with missing columns. The mainstream analysis says the IRA has more funds, the interface is cleaner, and everything will be easier to manage. The Securities and Exchange Commission tells financial professionals that a rollover recommendation should also consider penalty-free withdrawals, creditor protection, account costs, required distributions, services, investment options, and employer stock. Even the regulator's list is broader than the comparison many retirees receive. Then there is the incentive nobody enjoys discussing. FINRA has warned that a financial professional may earn commissions or asset-based fees when your 401k becomes an IRA under their management, while earning little or nothing if your assets remain in the employer plan. That does not make every rollover recommendation corrupt. It means the person presenting the recommendation may get paid when you say yes and receive nothing when you say no. You should know that before treating the recommendation as neutral. If an advisor charges 1% to manage a $1 million rollover IRA, that account can create $10,000 of annual gross advisory fees. Leaving the money in your employer plan may create no comparable revenue for them. Suddenly, you need more control is doing a remarkable amount of economic work. Ask the advisor 4 questions. How are you compensated if I roll over? How are you compensated if I stay? Have you reviewed my Rule of 55 eligibility and the plan's distribution terms? Have you analyzed creditor protection and the pro-rata consequences for Roth conversions? If the analysis begins and ends with investment choice, you did not receive retirement planning. You received an account opening presentation. Your financial advisor will not hand you the entire system because most of the industry gets paid to manage assets, not to calculate the exact point where work becomes optional. That gap is why I built a digital book called The Exit Code. It takes 50 years of actual retirement data and distills it into a mathematical framework for exiting the rat race. For someone considering leaving work in their 50s, the most relevant pieces are the 58% rule, which measures the buffer you need against a forced exit, and the framework that turns maybe someday into a specific retirement date. It also shows how to coordinate taxable, tax-deferred, and tax-free money instead of treating every account as an isolated pot. You can get it for less than a dinner out through the link in the description. Every year you wait changes the math, even when your plan does not. Once you understand the 3 hidden costs, the decision becomes a test of access, armor, and plumbing. Access means determining whether the 401k gives you a bridge to age 59 and a half. If you could leave your employer during or after the calendar year you turn 55, preserve the account until you have confirmed that you will not need the exception. Do not limit this to a planned retirement. Layoffs, health problems, caregiving, and corporate restructurings are not polite enough to consult your retirement spreadsheet. The account can act as an emergency exit even when your preferred exit date is later. A worker who expects to remain employed until 63 may still be separated at 57. If the money remains in the qualifying plan, the Rule of 55 can soften that forced transition. If the balance was moved into an IRA during an earlier consolidation campaign, the exit is narrower. Armor means identifying what legal protection the account provides and whether you have enough risk exposure to care. A salaried employee with strong insurance and few legal vulnerabilities may value this less than a business owner signing contracts, employing people, or owning multiple properties. The correct weight is personal, but the weight should never be assumed to be 0. Plumbing means examining what the account does to every future Roth transaction. Check traditional IRAs, rollover IRAs, SEP IRAs, and simple IRAs. Find your existing after-tax basis on prior Forms 8606. Confirm whether your current or future employer plan accepts incoming pre-tax rollovers. Then compare the visible benefits of the IRA. Measure the 401k's all-in administrative fees, fund expenses, advice fees, stable value options, and withdrawal charges. Compare those with the actual investments you would buy in the IRA, not an imaginary portfolio of every security available on Earth. More investment choices are valuable only when the additional choices improve your plan. A menu containing 8,000 funds does not help if you need 3 low-cost index funds. More choice can also create more opportunities to chase performance, trade during panic, and convert a good retirement plan into a hobby with tax forms. That is the brain problem behind automatic rollovers. Movement feels like progress. Consolidation feels organized. A new dashboard provides the emotional reward of having done something, even when the old account was performing a legal function you never noticed. The highest return decision may be leaving the account alone until a specific benefit expires. Lazy investing built more fortune than crypto memes. There are 3 reasonable outcomes. Keeping the 401k can make sense. When the plan is low cost, you may stop working before 59.5. ERISA protection is valuable, or you need to avoid a pre-tax IRA balance for backdoor Roth contributions. Splitting the account can make sense when you need enough money in the plan to fund an early retirement bridge, but want the rest inside an IRA for broader investment or withdrawal control. Calculate the bridge before transferring anything, and confirm that the plan allows the partial rollover and future partial distributions. A full rollover can make sense when you are past the early withdrawal window, the legal protection trade-off has been reviewed, backdoor Roth access is irrelevant or already addressed, and the IRA offers a measurable improvement in cost or administration. If you choose to roll, use a direct trustee-to-trustee rollover whenever possible. When an eligible workplace distribution is paid to you instead, mandatory federal withholding can apply, and you may need outside cash to complete a full rollover within the deadline. The clean operational method is usually moving the money directly between custodians. Before authorizing anything, obtain the summary plan description and ask the administrator to identify the exact language governing post-separation withdrawals. Confirm whether you can leave money in the plan, take partial distributions, select the timing, and roll only a portion to another account. Keep the response in writing. Retirement account call centers have a mysterious ability to produce 3 answers from 2 employees. The document controls when the conversation becomes a dispute. You should also check whether your plan contains exceptionally good investments that cannot be replicated in a retail IRA. Some workplace plans have institutional fund pricing or stable value options that individual investors cannot buy. Others are expensive relics. The account type does not tell you which one you have. The decision is therefore not 401k good, IRA bad. It is whether the rollover improves your complete retirement structure after accounting for taxes, law, timing, investment quality, and incentives. If you might retire before 59.5, the default should be caution. Preserve the qualifying 401k until the plan document and your withdrawal map prove that you no longer need it. A rollover form can be completed in minutes. Recovering a lost tax exception, a federal legal shield, or clean Roth plumbing can take years, assuming recovery is possible at all. Your retirement money does not become smarter because it moved. Before you roll it over, make the new account prove that it deserves the job. Investors cannot buy. Others are expensive relics. The account type does not tell you which one you have. The decision is therefore not 401k good, IRA bad. It is whether the rollover improves your complete retirement structure after accounting for taxes, law, timing, investment quality, and incentives. If you might retire before 59.5, the default should be caution. Preserve the qualifying 401k until the plan document and your withdrawal map prove that you no longer need it. A rollover form can be completed in minutes. Recovering a lost tax exception, a federal legal shield, or clean Roth plumbing can take years, assuming recovery is possible at all. Your retirement money does not become smarter because it moved. Before you roll it over, make the new account prove that it deserves the job.